Would you like to be able to find the next low yield, high growth stocks that will propel your portfolio to a whole new level? Well, today I'm going to look at how I've picked Alimentation Couche-Tard a while ago and how it has been successful in my portfolio, and how can you find the next Alimentation Couche-Tard for your portfolio today. Dividend growth investors, bonjour, my name is Mike Héroux and I'm the founder of Dividend Stocks. I also have this YouTube channel to help you invest with more conviction so you can enjoy your retirement. And not a critique, but a question that I receive often is, oh Mike, you did well with Alimentation Couche-Tard. We know that you are their number one cheerleader, and I'm actually should have like a t-shirt for them. But then it's like, it's easy to look at it today and it's already been like quite a success story. So how can I invest in the next one? Because this one, I found it overvalued. So today we're gonna look at Alimentation Couche-Tard and then we're gonna look at another one, because the process is always the same. The process starts with, you guessed it, a strong dividend triangle. So the dividend triangle, as you can see on this chart, is a component of like three characteristics. So revenue growth, earnings per share growth, and dividend. As you can see on this one, what you learn from Alimentation Couche-Tard by looking at a single graph is, first, the revenues are growing most of the time. Obviously, we have a dip during 2020 to 2022, but that is being explained by the COVID. When you look into the business model, you can try to find a link between the revenue trend and their business model. So it's always the same thing here. We're going to try to do that in this video, is to look at the numbers and find a narrative that fits with the numbers. If the narrative is the story, the investment thesis doesn't fit with the numbers that you have a discrepancy, and that's a red flag. So in this case, revenue is going up most of the time. Why? Because Couche-Tard is growing by acquisition. It is a business that always find other ways to grow. We're gonna see that in that video, but unfortunately, a lot of its volume comes from the sale of fuel. So we see that fuel sale has declined throughout the pandemic because of lockdowns. Totally makes sense. What is interesting and what the numbers is telling us is, while the sales are decreasing because of lower volume, the earnings per share kept increasing during this period. So it tells you, first, it's a business model that is quite recession resistant, or pretty much like resistant of everything. And the second thing is, when you dig a little bit deeper, you realize that the sales in the convenience stores have better margins. So that's one thing. And the second thing is, even though the volume for fuel was lower during the pandemic, the margin was better. So long story short, this company is resistant and always finds ways to make good margins, so increase their earnings per share. And obviously, the third component of the dividend triangle is the dividend growth, which is pretty clockwork here, double digit every single year for several years already. So that explains how the business is growing so fast. You see that in the numbers. So now we're gonna take a deeper look to their dividend growth profile first, just to see if it's going to continue or if there's a problem inside. So the number you see there are all numbers that are provided for more than 1,100 stocks at Dividend Stocks Rock. We offer all of those metrics, like about 50 metrics for each stock, so you can take a better decision. On this one, you can see that the payout ratio and the cash payout ratio are incredibly low, leading to a potential of more increase. And the 1 year, 3 years, and 5 years dividend increases, well, they're kind of crazy. We're talking about like more than 20% growth rate every single year. 13 years of dividend growth rate streak. So a very, very solid dividend growth profile. So the dividend triangle works. The dividend profile tells us that they're still on a roll. Now we have a solid foundation for the numbers, but what's the story? What explained the success story that we found at Alimentation Couche-Tard? And this is what you're gonna find into their investors website, into their presentation, their quarterly earnings, to know exactly what they do and what makes them so successful. So this is where you're going to build your investment thesis. So when you look at their investors presentation, and this is coming up from the latest one that was in October, I think, October or November or September of 2023, they explained that their strategy, so see now we're getting into the narrative, was evolving around 4 pillars. So the first one is getting better products inside their convenience store. So fresh fruit, their own brands, upgrading the offer for everything that you can find in convenience store. The second one was to improve their supply chains, get better margin throughout their fuel sales network. They already know that this is temporary. It's going to last for maybe another 10, 15 years. They're already preparing for the future with superchargers. They've done incredibly well in Norway, and now they're going to implement those superchargers in North America. The third pillar was to win the customer. So through loyalty programs, to getting a lot more information database, to build a database to know what the consumer wants, what does he buy, when does he buy it, how much does he spend, to optimize their convenience stores, to have digital experience as well. So just to make their life a little bit easier, to convince people to come to the convenience store more often. And we already know that Alimentation Couche-Tard benefits from prime location across the globe. The last one, winning growth. Well, this is where we're talking about mergers and acquisition. This has been the bread and the butter, the strongest expertise you can find at Alimentation Couche-Tard is those mergers and acquisition. They always pay the right price, they always make the right deal, and they're never afraid to walk away from a deal that doesn't sound right anymore. So that is the story. So when you look at this, you're thinking, yeah, it sounds incredible. But when you have the numbers backing up the story, you have a success story. You have a low yield, high growth stocks in your portfolio that is going to perform for a very long time. Now, is it time to buy Alimentation Couche-Tard today? The answer is going to come, but at the end of this video. Now we're going to move to another company that I found using the same methodology. So we're going to start again with a strong dividend triangle that have been taken from Dividend Stocks Rock Stock Screener. So you put minimum of 5% revenue growth, earnings growth, and dividend growth, and then boom, we got Tractor Supply. Tractor Supply, the largest farmer, rural provider for like recreational ranch as well, like small farms. So basically what they do is kind of like a Lowe's or a Home Depot / Walmart, but for people living on a ranch or in a rural properties. And they are like do-it-yourself type of person in the United States, and they just want to go to their own kind of like local general stores to buy their equipment, their supplies, and so on. So when you look at the dividend triangle, again, you see an incredible growth story. Revenues and earnings are growing at exactly the same pace or almost, so which is quite impressive. So that tells you that while the revenues are growing, the company is also able to maintain their margin to show similar trend for the earnings per share. Obviously, you see that the dividend growth is quite stable there as well. So what you see here is a very strong triangle, and then when you look at the price at the bottom of at the top of this graph, you see that the stock price has increased significantly, which is the reflection of a thriving business. So now when you look at the dividend profile, again, we have like a yield of 2%, the average 5 years at 1.3, so telling us that right now maybe there's a deal brewing because they're offering a higher yield than their past 5 years average. Payout ratio, cash payout ratio, still in line, pretty solid. Not as solid as an Alimentation Couche-Tard, but still a lot of room to grow here. The 1 year, 3 years, 5 years dividend growth, we have something incredible for the 5 years and 3 years. Double digit for the last year, like 12%. It's good, but it's not crazy. That is also normal because at one point you cannot really expect a business to grow their dividend by 20, 25, 30% year after year, right? So double digit growth rate, sufficient for me enough. 14 years of dividend growth streak. So again, we are in the middle of a growth story, and now we need to find what's going on with Tractor Supply. Like what makes them so special? What makes them grow? Because for Couche-Tard was like those 4 pillars. That was the narrative that we were missing. So what I did is I went on Tractor Supply investors relation website, looking at their annual earnings, their quarterly earnings, their investment presentation, just to get a little bit more information about Tractor Supply. So first I've discovered that they have the kind of like perfect niche where they are mostly based in rural areas where they're a bit far away from the competition. So people are not thinking about going to Walmart, Lowe's, or Home Depot. They're just saying, you know what? The best store in town is Tractor Supply. The store has been designed for me to find everything and to have like competent people inside. So if I have questions because I have like a bunch of DIY projects, they will be able to answer my question. So a little bit more high-end type of products, bigger equipments as well. So kind of like protected from e-commerce. They still have like a wide distribution network across the rural area, which provide them kind of like a very strong foundation for growth. So that explains the situation in terms of like that could be a very solid, mature business. Tractor Supply has been in business for the past 85 years, so it's not a brand new company. But now, what about growth, right? So you want to see a little bit more about what are they going to do to continue what they have been doing right now, and is it possible that this dividend triangle will look the same in 5 and 10 years from now? So digging a little bit deeper, I saw that the bulk of their strategy revolves around two main points. The first one and the most important one is growing the number of stores. So store opening. So you may think, well, okay, that's pretty much obvious, right? But here's the thing. Right now they have 2,181 stores and they want to go up to 3,000. Now the goal is to open almost 100 stores per year through 2025, and then after that we're gonna have like probably like 70, 80 new stores every single year. That gives us roughly for almost 10 years of growth if they are able to complete that strategy successfully. What tells me they are able to do that? Well, the management in place seems very strong. They've been in business for 85 years and they've been applying this business model, their growth business model, for several years now with a lot of success. So they benefit from that brand recognition. They have like a specific, unique type of like look and feel when you enter into those stores, and they want to expand their business elsewhere. The second growth vector, which I found even more interesting because that is going to bring even more organic growth inside the existing store, is to focus on their PetSense acquisition. So they also now provide a bunch of products for animals, which kind of makes sense if you're living in a rural area. You also have like animals, that is like almost for sure. So then you can go to Tractor Supply, get your equipment, get your supplies, and on top of that, get everything you need for your pets. So that totally makes sense. Expanding the brand PetSense also will including those PetSense boutique inside Tractor Supply. So that was a pretty strong way to grow their organic growth. And the second thing is to also expand their stores with gardening center. They already have like more than 400 stores with gardening centers, but this is also something that they want to expand. They've noticed that Home Depot is generating a lot of money from their gardening centers, so they thought, well, we might grab a few market shares here and make even more money while you have the same customer getting to the store, but just buying more, so increasing the average tickets, the average amount spent per transaction. So once I've identified a business with a strong dividend triangle and with a narrative that support that triangle, and I can believe I can see that there's definitely at least 5 to 10 years of growth for Tractor Supply coming up, then the last thing I want to do is I don't want to necessarily overprice for it. It's really hard to determine what is the good price, so I don't spend too much thought onto it. And honestly, if you ask 12 people the right price to buy Tractor Supply or Alimentation Couche-Tard, you're going to get 12 different answers. So you might as well just have your own process and focus on what you want to do instead of spending like hours and hours doing calculations, because you know what? The guy next to you has spent the same number of hours of calculation, has probably the same background, or even he's smarter and he has a different answer than you. And you know what? You're just going to know which one is right in a year from now. So what I like to do is I like to look at the average 5 years dividend yield and the average 5 years PE ratio, compare it to what it is right now. Because most of the time, the market tends to give the same valuation for a business, especially if they have a stable business model. In this case, if you look at Tractor Supply, the current PE ratio almost 21, the forward PE ratio 19, but the average of the past 5 years, 23.74. So remember, I told you that there might be a deal here because the yield was higher than the average 5 years. Well, then we have the same thing for the PE ratio. Right now it's trading at a lower valuation than what it is trading for the past 5 years. Kind of normal because the market's concerned. If you open a lot of new stores, this means that you're going to get into more debt, and the debt right now is not cheap. So will they be able to grow their business and maintain their margin? This is still a risk. They're going to, as they expand, they will also face additional competition because they're going to get closer and closer to the Home Depot, Walmart, and Lowe's of this world. So all of that tells you, yeah, there's some kind of risk, but the number still makes a lot of sense. The narrative fits the dividend triangle, so I find it quite interesting. Now, if you want to know more about how to find low yield, high growth, I do have a full webinar, which is actually today on November 2nd. But if you watch this too late, don't worry, you can click on the link below and you're still going to be forwarded to the replay for the webinar. So I'm going to share you my entire methodology, how I build portfolio, how I manage them, and how I can generate income at retirement from this type of portfolio. Because again, you're going to tell me, but Mike, I cannot retire on 2% or 1% yield. Yes, I do have a strategy for you that will help you to establish the withdrawal mechanics. So just go in the link below, register to the webinar if it's not too late if you watch this in the morning, and if not, if you click on it, you'll see the replay. And to end this webinar, the final question: what would I do if I didn't have Alimentation Couche-Tard in my portfolio today? Would I buy more, or would I buy it right away because it's overvalued, right? It's always overvalued. Well, guess what? You're actually paying the exact same price that you would have paid 5 years ago. Kind of crazy, right? But 5 years ago, Couche-Tard came with their double again strategy. They wanted to double their earnings from 2028 to 2023. Well, first thing, congratulations, Couche-Tard, because you made it. You're on track to not only double, but go a little bit over doubling your earnings per share over the past 5 years. The best part, it's still trading at the same PE ratio and it was 5 years ago. So there's no PE expansion, there's no market going crazy, there's no hype around the stock. The stock is trading a higher price because they doubled their earnings. So you're just paying the same multiple that you would have paid in 2018. That tells me, well, you know what? All of those pillars are still there. The dividend triangle is incredibly strong. The narrative is still there. And the valuation is pretty much the same. So what would prevent me from buying Alimentation Couche-Tard right now? I don't see where it's overpriced and overvalued. Of course, I wanted to buy the stocks at 30 bucks, but at 30 bucks, I did it when it was trading there in 2018. Today, if you're buying it at 70 bucks, it's pretty much the same valuation. So long story short, you still have a chance to buy an amazing business that is still on the growth path. All right, guys, I hope that you have enjoyed this video. Let me know about other low yield, high growth stocks that you like in the comments below. Tell me if you have been investing in Alimentation Couche-Tard or if you're looking at Tractor Supply, which, full disclaimer, I don't have in my portfolio, but I must admit, I found it quite intriguing. All right, guys, that's enough for today. Don't forget to give me a thumbs up, like the video, and also subscribe to the channel. And we're going to talk again next week, so stay invested.